payments that a company makes to its shareholders. The money comes from its net profit, that is, profit after paying corporate tax. When people buy shares in a company, they expect a return on their investment from dividends and the appreciation in the value of the shares. That is, when they sell the shares, their aim is to make a profit. Dividends usually reflect how large or small a company's profits are. Dividends are a way for businesses to distribute revenue back to investors. Shareholders are liable for income tax on the dividend money they receive. In most countries, the company does not get a corporate income tax deduction for dividends. The board of directors of public companies decide how much to pay out in dividends to shareholders. They cannot pay out too much, otherwise there will not be enough for investment and research and development. However, if dividends are too low or non-existent, there is a risk that the shareholders will sell their stocks and invest somewhere else. If people start selling a company's shares in large numbers, the share price declines. Shareholders receive their dividends either in cash or as shares of stock if the company has a dividend reinvestment plan. DRIP, which stands for Dividend Reinvestment Plan or Dividend Reinvestment Program, is an equity investment option that some companies offer. In such plans, the shareholders' dividends are automatically reinvested in the underlying equity. In the 17th century, the Dutch East India Company started paying out dividends. It was the first company in the world to do so. For nearly 200 years, its annual dividend payments were worth approximately 18% of share value. The Dutch East India Company was founded in 1602 by the Dutch government and several rival trading companies. It was a transcontinental employer and pioneer of outward foreign direct investment. The dividend payout ratio is the proportion a company pays to its stockholders in dividends from its profits. In other words, the percentage of earnings paid out to shareholders. In the UK, the term dividend cover is more common. We calculate this ratio by dividing earnings per share by dividends per share. The dividend price ratio is also known as the dividend yield. It refers to a share's dividend as a percentage of its price. We can also calculate it by dividing a company's total payments to shareholders by its market capitalization. Dividend price ratio and dividend payout ratio are the most commonly used ratios that shareholders calculate.